Index fund owners, hold your breath. Big news.
Welcome to the Deep Dive, brought to you by SponsorName, your trusted partner for clear financial insights. Okay, this weekend, it really dropped a bombshell, didn't it?
It certainly did. Major headlines.
Yeah, we're diving straight into these dramatic headlines. The U.S. has launched strikes on Iran's nuclear facilities, and suddenly the question on everyone's mind is $100 oil coming back?
Right. And will market panic hit your portfolio? That's the core concern.
Exactly. So today we're cutting through all the noise. We're going to explain exactly what happened.
Why it matters for your investments.
And maybe most importantly, what actionable steps you can actually take right now.
And this isn't just, distant geopolitics playing out somewhere else. This is about understanding the immediate ripple effects on global energy markets, the potential for inflation.
And ultimately, yeah, the impact on your hard-earned assets, your savings, your investments.
We've really dug into this. We've got a stack of sources here for you. Everything from emergency market briefs to deep historical analyses and even insights from some of the world's most renowned financial gurus.
All aimed at helping you navigate these, well, exceptionally uncertain waters with some clarity.
Hopefully.
And we're not just going to tell you what happened. We promise more than that. We're going to give you those immediate market projections, dive deep into history to see how similar events played out. Patterns are key, right?
Absolutely. History often rhymes, even if it doesn't repeat exactly.
We'll share direct wisdom from investment legends like Buffett and Dalio.
Can't go wrong listening to them.
And arm you with a concrete, practical checklist for your portfolio. Things you can actually do.
Actionable intelligence.
So stick around. Warren Buffett's timeless playbook is coming up in just about 60 seconds. This is a deep dive you absolutely won't want to miss.
Okay, so let's unpack the core event first. What exactly happened this weekend? Well, the key facts are these. On June 22nd, 2025, the United States launched direct military strikes. The targets were 3 of Iran's key nuclear sites: Fordow, Natanz, and Esfahan.
And just to be clear, this isn't just another, minor flare-up in regional tensions we sometimes see.
No, absolutely not. This is a significant, direct military escalation, a move that has already sent, frankly, palpable shockwaves across global markets, even before the full trading week has properly begun.
Right. And the analysis we've seen, like from that energy markets post-strike emergency brief, highlights this action has immediately injected this new substantial layer of geopolitical risk into the global economic outlook.
It really is a potential game changer.
So how does that translate into markets? How quickly does this geopolitics hit pricing?
Oh, instantly. What's critical to understand, we're already seeing an immediate tangible impact. We call it a geopolitical shock premium.
Shock premium.
Okay. Yeah, and this is before official trading really gets going. Analysts across major desks, Rystad, ZEF, Sexo, they're actually in rare agreement on this. They figured this event has instantly added about $3 to $5 per barrel premium onto the price of oil.
$3 to $5, just like that. Wow.
Just like that.
Yeah.
It's the market's immediate way of pricing in this huge uncertainty, the potential for supply disruption. And that's even without any physical barrels being impacted yet. It hasn't happened, but the risk is there.
So that premium tells us exactly how quickly geopolitics can collide with your portfolio.
Precisely.
And when we talk about that immediate impact, we're looking at what you'd call a classic knee-jerk reaction in crude oil futures, right?
Exactly. Knee-jerk is the right word. Take Brent crude futures for August 2025. They closed Friday around, $77.01 a barrel.
Okay.
But the projections, Reuters is already reporting this, they're expected to gap up by that $3 to $5. So potentially opening near $80, maybe even $82 a barrel, purely based on this newly priced-in risk.
And WTI, the U.S. benchmark, same story.
Pretty much the same story. WTI for July 2025, that closed Friday, around $73.84. Sources suggest it could open around $78, $84. So again, a jump of maybe $4 to $5.
Okay, so oil prices are poised to sprint higher faster than my treadmill resolution.
That's one way to put it. It's a dramatic move right out of the gate.
Yeah, sets the stage for what could be a very volatile week ahead, I imagine.
No doubt about it.
So why? What are the specific drivers behind this expected surge, beyond just the initial shock?
Right, it's multifaceted. That energy markets post-strike emergency brief really breaks it down well. Beyond that initial shock premium we mentioned, there's a really serious element of retaliation math at play.
Retaliation math, explain that.
It's basically the market calculating the odds and impact of Iran hitting back. If Tehran chooses to retaliate, say, with drone or missile attacks targeting Gulf Cooperation Council GCC export terminals.
Or maybe even worse, the tankers carrying the oil.
Exactly. That's the big one. If they hit tankers, multiple financial desks, MST Marquee, ICAS, or mentioned, they're projecting Brent crude could hit $100 a barrel.
$100 within days.
Within days. This isn't some long-term forecast. It's the immediate direct consequence of what we call a tail risk scenario.
Low probability, but massive impact if it happens.
Precisely. And the market is now seriously considering that possibility.
And this brings us to the real wild card in all this, doesn't it? The Strait of Hormuz.
Absolutely critical. For anyone listening who isn't familiar, this isn't just some random bit of water. It's incredibly narrow, just about 2 miles wide at its tightest point.
2 miles?
Yeah, but its strategic importance is just immense, almost impossible to overstate. Roughly 20% of the world's global crude oil and liquefied natural gas, LNG, moves through that choke point.
20% of global supply.
Wow. So if that gets disrupted, well, JP Morgan estimates, cited by Reuters, suggest a full closure could catapult crude prices to an astonishing $120 to $130 a barrel.
$120 to $130.
Yeah.
It's huge. Is that a real threat?
It is. Maritime groups like BIMCO, they've already issued warnings. They're saying shipping threats around the Arabian Peninsula are rising. And Iran does possess the capability, anti-ship missiles, drones, to disrupt this vital passage. The potential for disruption there is truly immense.
Okay, so it's not just oil then. What about natural gas? Is it feeling the heat too?
Oh, definitely. It's crucial to understand these markets are very much intertwined, especially because of that LNG flow risk we just talked about through Hormuz.
Right.
In the U.S., Henry Hub natural gas prices, they've already climbed 7% week to date.
7% already.
Yeah. Now, part of that is admittedly fueled by, triple-digit heat index forecasts driving up domestic demand for air conditioning.
Yeah.
But a substantial portion is also because of speculative hedging against potential Middle East LNG disruptions. That's noted by MRT.com.
In Europe, they're even more reliant on LNG imports now, aren't they?
Very much so. And you saw it there, too. The TTF July 2025 contract, that's the key European gas benchmark, it saw a notable 4% pop on Friday, reached about 37.7 euro per megawatt hour.
Biggest jump in a while, I heard.
Biggest one-day jump in 5 weeks, actually. And it was precisely because traders are eyeing that LNG route risk via the Red Sea and, of course, Hormuz. That's according to ALA.com.tr.
So, yeah, not just a ripple in crude, but across all globally traded energy commodities.
Yeah, exactly. And when we talk about LNG flow risk, Bloomberg specifically notes that shippers are now being advised to, quote, reroute or reassess their passages through the Gulf.
Reroute or reassess, that sounds serious.
It is, because any major diversion or delay could significantly tighten the supply of LNG, especially in the Atlantic basin. For regions like Europe, which, as you said, have become increasingly reliant on LNG imports, particularly from North America.
Yeah.
This tightening could easily push North American contract prices higher and pose a really substantial challenge to European energy security. It's a very real concern.
Okay, and you mentioned jargon earlier. Can you quickly explain gap risk for everyone?
Sure. Yeah, good point. So when you talk about gap risk, we're describing a situation where the market price for something, like oil, opens significantly higher or sometimes lower than where it closed the previous trading session.
Right, like that 3 to 5-fold jump we expect in oil.
Exactly. It typically happens because some major market-moving event like these strikes occurred when regular trading was paused, like over the weekend. So it literally creates a gap on the price chart when trading resumes. The market has to instantly adjust or gap to catch up to the big news all at once.
Got it. Makes sense. Now, to try and put this current, pretty stressful situation into perspective, history often gives us the best lessons, right?
It really does.
We've delved into past geopolitical flashpoints that seem to closely mirror this U.S.-Iran shock to see what patterns emerge.
Because it's not just about what happened this time. It's about what usually happens in these scenarios and maybe where the common pitfalls lie for investors.
Exactly. Learn from the past.
And what's truly fascinating here is, while every crisis definitely has its own unique elements, there are remarkably clear patterns in how energy prices react. We've carefully selected 3 key moments from our research. Let's call it the geopolitical flashpoints in energy prices, a historical guide to illustrate this.
Okay, 3 moments.
Yeah. These aren't just isolated incidents. They reveal a larger playbook the market tends to follow when faced with these kinds of shocks.
All right, history bite number 1. Let's go back to the 1990 Gulf War. Specifically, Iraq's invasion of Kuwait in August 1990.
A huge shock to the system back then.
Massive. And the market reacted incredibly sharply. Crude oil, which was then trading around, what, $17 a barrel?
About that, yeah.
It jumped an astonishing 112%. 112%. Up to $36 in just 10 weeks.
Incredible surge.
But here's the crucial lesson from that moment. Something that often gets forgotten amidst the initial panic.
What's that?
The fear premium collapses if supply proves safe. That's the key takeaway.
Right. So once the coalition victory looked clear, and the market realized that fundamentally oil supply would remain largely uninterrupted,
What happened to prices?
they actually reversed course pretty dramatically, fell back below $20 a barrel.
Wow. And natural gas back then, different story.
Very different. It was a much smaller global commodity trade at the time. We didn't have the huge global LNG market we have now, so natural gas only saw pretty minor single-digit price rises, not the same complex interplay we see today.
Okay, moving forward in time, history bite number 2. The 2019 Saudi Aramco Abqaiq drone strike. Much more recent.
Yes, September 2019. And this was different drones struck the absolute heart of Saudi Arabia's oil production infrastructure. Abqaiq temporarily took out a significant chunk of their daily production capacity.
In the immediate market reaction, I remember that being pretty wild.
Staggering is the word. Brent crude opened around $71.60 and jumped an incredible 19% intraday.
19% in one day.
Yep, that was the largest single-day percentage move on record for crude oil.
Wow. But what was the lesson there? Because it didn't stay up, did it?
No, it didn't, and that's the critical lesson. Fast repair news erased most of the premium. The price gave back about half of that massive gain within just 1 week. Why? Because news emerged that the Saudis were repairing the damage much faster than initially feared.
So it underscores how quickly the market differentiates between the fear of disruption and actual sustained physical disruption.
Exactly. Perception versus reality.
Okay, history bite number 3. Even more recent, and one that's probably fresh in everyone's minds. Russia's full-scale invasion of Ukraine in February 2022.
A truly seismic event for energy markets.
Now, Brent crude definitely jumped, right? It went up about 34% to $130 a barrel within 10 days. Significant move.
Very significant. But the real shock, the truly unprecedented move, was actually in natural gas.
Ah, right. European gas prices went crazy.
Absolutely stratospheric. European TTF gas surged an incredible 50% in a single day, reached over €200 per megawatt hour.
5 times higher over the summer.
It saw a 5-fold rise through the summer, yeah. The lesson here is crystal clear, and it's vital for today's context. This was the biggest gas shock ever, because pipelines were the target.
The infrastructure itself was hit.
Directly. This conflict starkly highlighted natural gas's extreme sensitivity when the actual supply infrastructure, especially pipelines in that case, is directly targeted or weaponized. Oil's price spike lasted maybe 2 months before starting to fade, but gas prices, they remain highly elevated for 6 to 9 months. Very different dynamics compared to crude.
Okay, so if we connect these historical dots, what's the bigger picture? What's the general playbook history gives us?
Well, first, there's almost always that immediate knee-jerk reaction we talked about. Front-month crude typically leaps, say, 4% to 20% in the first 24 to 48 hours. That seems standoff.
So the really massive spikes, like 1973, 1979, 1990.
Those only occurred when actual physical barrels genuinely vanished from the market. Not just headlines, not just threats, but actual tangible supply loss. That distinction is absolutely paramount.
Okay, and that leads directly to what you called the half-life of fear.
Exactly. If, ultimately, the shipping lanes stay open and the oil fields remain operational and undamaged,
Then what?
then that initial fear premium usually burns off pretty quickly. We're talking days, maybe a few weeks.
Yeah.
We saw that pattern in 2019 after Abqaiq, in 2020 after the Soleimani strike, even back in 2003 during the Iraq war buildup.
So it's the physical disruption that dictates sustained high prices, not just the initial scare.
Precisely.
And the takeaway on natural gas sensitivity.
It's much more specific. Gas prices only surge in that really dramatic fashion when the conflict directly impacts gas supply itself, like the pipelines in Ukraine 2022. Or, crucially for today, when critical LNG choke points like the Strait-of-Hormuz are genuinely threatened or disrupted.
Which makes that Hormuz risk incredibly relevant right now.
Highly relevant.
What about buffers, like spare capacity or government reserves?
Yes. Spare capacity and strategic petroleum reserves, SPRs, they matter hugely. Large spare production capacity, mostly held by Saudi Arabia and the UAE, or significant government FBR releases can dramatically shorten the length and intensity of any oil rally. We saw this work effectively in 1991, 2019, and 2003.
They act like shock absorbers for the market.
Exactly. Vital shock absorbers.
And finally, that macro feedback loop you mentioned.
Yes, this is really important. Extended oil price spikes, meaning those lasting more than, say, 3 months, reliably lead to higher inflation across the board. This, in turn, complicates things for central banks. It can delay expected interest rate cuts or even force hikes.
Which then puts pressure on equities, on stocks?
Yes, exactly. Higher inflation, potentially higher rates, that's generally bad news for stocks. We saw this clearly during the 1979 stagflation period, and again with the CPI shock we all experienced in 2022 after the Ukraine invasion.
So it's not just an energy story. It quickly becomes a broader economic story with serious implications for all assets.
Couldn't have said it better myself.
Okay, when markets get this turbulent and the headlines are just screaming uncertainty, we often instinctively turn to the gurus, right?
Mm-hmm. The legendary investors.
The ones who've not only seen it all, but somehow navigated it successfully. We've pulled some fresh, highly relevant comments from the top names.
Their collective wisdom often cuts straight through the noise, providing really profound insights.
Let's hear what they're saying. What about Bill Ackman? Pershing Square.
Right, Ackman. He had some strong words. He actually called the U.S. strike one of the greatest military achievements ever. Quite a statement.
Wow. Okay. But did he comment on the market impact?
He did. And this is crucial. He issued a stark warning, saying that closing the Strait of Hormuz would send oil above $100 in the blink of an eye.
So even with the military precision he admired, the real financial leverage, the market-moving power, still rests with that narrow strait.
Exactly. It highlights the potential economic consequences if that choke point were truly disrupted.
So the practical takeaway from Ackman for you, the listener:
expect that headline-driven oil price spike, sure, but rather than just betting on a quick peace deal.
Which might be wishful thinking.
Right. The focus should probably be on hedging against the potential inflation risk that this kind of tension inevitably brings.
Okay, next up, the Oracle himself, Warren Buffett. What's his take? Still preaching calm.
You guessed it. In March, he apparently re-emphasized his classic, timeless rule: keep your head.
Keep your head. Simple, but hard to do sometimes.
Incredibly hard. His advice is profound in its simplicity, especially in volatile times. Stay calm, resist that powerful urge to panic sell, and perhaps most importantly, look for opportunities. Opportunities to buy high-quality assets when others are succumbing to fear.
It truly is the cornerstone of his long-term success, isn't it? When everyone's hitting sell, take a deep breath.
Exactly.
So the practical takeaway for your portfolio:
don't dump your core long-term holdings based on these initial scary headlines. Instead, try to view any broad market sell-off as a potential opportunity. An opportunity to perhaps add to high-quality companies or low-cost index funds that align with your long-term financial goals.
What about Ray Dalio, Bridgewater?
Yeah.
He often takes a bigger picture view, right?
He does. And his warning resonates deeply right now. He cautions that the global order itself seems to be at a breaking point. Feels that way sometimes.
Yeah.
So he urges investors towards long-term strategic planning, thinking beyond the next few weeks or months. He stresses broad diversification across different asset classes and regions, and a strong focus on hard asset hedges, like commodities or real assets.
So he's saying look beyond the immediate headlines and consider these deeper structural shifts happening globally.
Precisely. It's about building resilience for a potentially very different world order.
Which raises that important question. How are we building our portfolios for the long haul in a world that feels increasingly fragmented, more unpredictable?
It's the key question.
And the practical takeaway from Dalio?
Diversify. Diversify well beyond just U.S. equities. Blend your stocks with gold, maybe other tangible commodities, perhaps even non-USD assets. The goal is to spread your risk and insulate your portfolio from shocks specific to one country or one currency.
Okay, now this is interesting. What about bond gurus? Jeffrey Gundlach, the bond king, and Mohammed El-Arian, formerly of PMCO. Are bonds still the safe haven?
Well, this is where it gets really fascinating. Gundlach has stated, pretty unequivocally, long treasuries aren't a flight to quality asset anymore. Gold is suddenly the flight to quality asset.
Oh, wow. Gold is the new treasury bond, in his view.
That seems to be his point. And El-Arian echoes this. He notes that recent safe haven flows, money looking for safety, seem to be moving distinctly towards gold and silver, not towards traditional treasury bonds.
That is a pretty stark shift from conventional wisdom, isn't it? Bonds usually got the safety nod when things got shaky.
It's a major shift in perception, yeah.
So the practical takeaway for you.
Consider shifting a portion of your portfolio's safety bucket away from long-duration bonds. Instead, maybe allocate it towards precious metals like gold or even very short-term T-bills, which are less sensitive to interest rate moves.
And critically, don't just assume bonds will automatically rally and protect your portfolio if this crisis deepens. The game might have changed.
The safe haven dynamics seem to be evolving.
Okay, one more guru. Paul Tudor Jones. Tudor Investment. What's his perspective?
Jones focuses on the policy environment. He points out that policymakers are essentially trapped in an environment of negative real rates.
Negative real rates.
Yeah.
Meaning inflation is higher than the interest rates you can earn.
Exactly. Your return after accounting for inflation is negative. Your purchasing power is actually eroding, even if you're earning some interest.
So what does he recommend in that environment?
His direct recommendation is to embrace gold and inflation hedges as the core playbook for investors right now, precisely because traditional monetary policy seems constrained.
Got it. So if we try to synthesize all this wisdom from these giants, Ackman, Buffett, Dalio, Gundlach, Jones, what's the common thread?
It really seems to point towards a critical need for robust inflation protection in portfolios, and alongside that, maintaining a calm, disciplined, and broadly diversified approach that's really attuned to this changing global order and shifting safe haven dynamics.
And the practical takeaway from Jones specifically.
Ensure you own some exposure to gold or broader commodities. And for those who are more active traders, perhaps consider using defined risk strategies like call spreads on oil or energy ETFs instead of just buying stocks outright. It gives you a way to participate in potential energy upside, but with a capped risk, which is crucial given the current volatility.
Makes sense. Control your risk. All right, with that guru wisdom echoing in our ears, let's talk specifics. Sectors.
Okay.
In a crisis like this, some areas of the market will naturally shine, right? They might act as safe havens or be direct beneficiaries.
While others become far more vulnerable, facing significant headwinds.
Exactly. It's all about understanding where the money flows when risk perceptions shift so dramatically.
Okay, let's start with the shining sectors, the potential winners. First up, no surprise here, energy. Specifically, upstream exploration and production companies, the drillers, and the big integrated oil giants.
Why them? Seems obvious, but let's spell it out.
It's straightforward math, really. Every $5 risk premium lift in Brent or WTI crude, that drops almost straight to these producers' bottom lines, their profit margins.
So higher prices equal higher profits pretty directly.
Very directly. Analysts are projecting that immediate $3 gap higher at Sunday's open, as we discussed. And they see that significant tail risk of oil potentially hitting over $100 if Iran actually disrupts the Strait-of-Hormuz.
And if someone wants broad exposure here, an ETF.
A highly liquid and accessible one is XLE. That's the Energy Select Sector SPDR fund. Covers the big players.
Okay, XLE for energy. Next shining sector.
Aerospace and defense.
Also pretty intuitive when geopolitical tensions escalate like this.
Exactly. You typically see a rapid increase in demand for defense hardware. Think about it. Gulf states will likely rush to buy more missile defense systems, advanced drones.
And the U.S. and its allies will need to restock.
Right. The U.S. and NATO will probably look to restock precision munitions, upgrade their surveillance capabilities, and so on. We already saw defense stocks jump 3–5% on the initial headlines. The market anticipates increased spending.
Makes sense. An ETF for that sector.
XAR is one. The SPDR S&P Aerospace and Defense ETF. It gives you targeted exposure.
Okay, energy, XLE, defense, XAR. What's the third shining sector? Does it align with the gurus?
Perfectly. Precious metals and gold miners.
Gold. The safe haven.
It's acting exactly like one. Gold already hit a 2-month high, soaring above, I think it was $3,400 an ounce.
Wow.
Yeah, as investors globally fled to what they perceive as a true store of value amidst all this uncertainty.
And the miners offer leverage to that.
Correct. Gold miners offer leveraged upside to rising gold prices, meaning their profits and potentially their stock prices can grow even faster than the price of gold itself.
How can investors get exposure?
Well, for direct gold exposure, there's GLD, the SPDR Gold Shares ETF, or if you want that leverage play on the miners, there's GDX, the Van Eck Gold Miners ETF.
GLD for gold itself, GDX for the miners. Got it. They're tied directly to that flight to safety dynamic.
Exactly.
Okay, let's quickly touch on one more potential winner, if time allows. LNG, liquefied natural gas infrastructure.
Yes, potentially. Remember, Hormuz handles about 20% of global LNG flows, too.
Yeah.
If that route becomes risky or blocked, Flows might need to be diverted, potentially benefiting U.S. and Canadian exporters.
And the companies that transport it.
Midstream companies, LNG tanker companies, they could benefit. An example ticker here might be FLNG, which is FLEX LNG Ltd, a tanker company, but this is perhaps a more specialized play.
Okay, good to know. Now let's pivot. The vulnerable sectors, the potential losers, or at least those facing serious headwinds.
Right. First on that list, airlines and other transport companies.
Fuel costs, remember.
It's all about fuel costs. These sectors are incredibly sensitive to the price of oil. Higher oil prices directly squeeze their operating margins. They might try to pass it on through higher ticket prices, but that risks reducing consumer demand for travel. It's a tough spot.
So when you're stress testing your portfolio for $90, $100 oil,
you absolutely need to carefully examine your exposure to the transport sector. Airlines, shipping, trucking, they're all vulnerable.
Okay, transport. What's the other major vulnerable area?
Consumer discretionary sectors.
Explain the connection.
Think about it this way. If sustained high oil prices act like an effective tax on consumers.
Taking more money out of their pockets at the gas pump.
Exactly, reduces their disposable income. So what's the first thing people tend to cut back on when money gets tight?
Non-essential goods and services. Eating out, new clothes, vacation.
Precisely. Dining out, apparel, travel, electronics, all those non-essential items. If you're paying significantly more for gas and heating, you have less discretionary cash left over.
And this links back to that macro feedback loop we discussed.
Directly. Extended oil spikes, hitting consumer spending, potentially exacerbating inflation, maybe delaying central bank easing. It puts broad pressure on equities, especially consumer-facing ones.
Okay, so knowing the winners and losers, how do you practically position your portfolio in this kind of dynamic environment? Let's talk strategy.
Right, it depends a bit on your goals and risk tolerance. For growth or alpha seekers, those looking for higher returns and willing to take more calculated risk, they might consider adopting what's called a barbell strategy.
Barbell, meaning weighted at both ends.
Kind of. It means going long on sectors expected to benefit, like energy, XLE, and defense, XAR, to capture that oil price sensitivity or beta and the military spending boost, but maybe balancing it or funding it by being underweight or short sectors expected to suffer, although shorting is risky.
And you mentioned using options earlier, like call spreads.
Yes, particularly for energy and defense right now. Because their volatilities are already elevated, just buying calls can be expensive. Using call spreads limits your upfront cost and defines your maximum risk, which is crucial if volatility suddenly drops, or what we call freshes.
Okay, that's for the growth seekers. What about for core or balanced portfolios? People focused more on resilience.
The approach is different there, more about stability. You might consider maintaining a modest energy overweight, maybe 3% to 8% above whatever your normal benchmark allocation is, especially while this geopolitical risk premium holds in the market.
So a slight tilt, not a huge bet.
Exactly. And crucially, ensure you have that gold allocation we talked about, maybe 5% to 10% of your portfolio, via GLD or even physical bullion if you prefer. That's your explicit hedge against geopolitical tail risk, the really bad scenarios.
And don't forget the defensive parts of the portfolio.
Absolutely not. Keep your defensive sectors intact utilities, like XLU, consumer staples like XLP. These tend to hold up better in downturns and provide valuable ballast, smoothing out the overall portfolio volatility during uncertain times like these.
Now, what should people specifically avoid doing right now? Any big pitfalls?
Definitely. First, as we heard from Buffett, avoid chasing those wild, parabolic oil price moves with high-leverage ETNs or excessive margin.
Those leveraged products can cut both ways. Fast.
Very fast. They're designed to amplify returns but also losses, and they suffer from decay over time. Especially during volatile back-and-forth swings, those whipsaws, you can lose money even if oil ends up higher.
Okay, avoid chasing with leverage. What else?
Don't just assume treasuries alone will protect you. As the gurus warned, the traditional safe haven playbook seems to be shifting, with gold gaining prominence. Diversify your safety assets.
Good point. Anything else to avoid?
Avoid over-concentration in one single narrative or outcome. As we've discussed, there are multiple ways this could play out. Quick de-escalation, prolonged tension, even wider conflict. Your portfolio should be flexible enough to handle various scenarios, not just the one you hope for or expect. Don't bet the farm on a single outcome.
All right, let's dive into the options corner for those listeners who use them.
Okay.
For folks looking to manage risk more precisely or maybe express a specific directional view, options can be incredibly powerful tools, can't they?
They absolutely can be.
Yeah.
But, and this is a big but, they also come with their own unique set of risks, especially in highly volatile environments like the one we're in right now.
Yeah, you really need to understand what you're doing. Potential reward, but also potential loss.
Absolutely. What's truly fascinating right now is seeing how the options markets are immediately pricing in this geopolitical shock.
How so?
Well, oil volatility, which we often measure using an index called OVX, has already jumped significantly to levels not seen since Russia's 2022 invasion.
So the options market is saying big moves expected in oil.
Definitely. But here's the interesting part. Equity volatility, measured by the VIX index for the S&P 500, remains relatively muted, much lower.
So fear is concentrated in energy options, less so in the broad stock market.
Exactly. This disparity tells us where the immediate market fear is most focused. It leaves options traders intensely debating whether to buy this spike in oil volatility, expecting more big moves, or fade it, betting that the fear is overblown and volatility will come back down.
Okay, so let's quickly review what kind of moves are currently priced in by the options market. What are the expectations baked into option prices right now?
Sure. Based on the options data for WTI crude July contract, the market is pricing in that $4 to $5 gap higher at the open we discussed. And looking at its implied volatility, or 4DT, that's the market's expectation of future price swings.
Right.
The cost of options betting on a price increase, what we call call skew, is at its highest level since 2022.
Meaning traders are paying up significantly for bets on oil going much higher.
Precisely. They're really pricing in a potentially large upside move. For Brent, the August contract, it's a similar story. That $3 to $5 gap is expected, and there was reportedly heavy buying of calls above the $90 strike price last week, again signaling strong bullish conviction.
Okay, that's oil. What about the broader stock market, the S&P 500, the SPX?
There, the street seems to expect a more modest knee-jerk dip, maybe negatives 1% to negatives 2%. But critically, the front-month VIX index, the market's main fear gauge, is still below 20.
Which is relatively low, historically speaking.
Yes. It indicates that despite the Middle East headlines, there's still plenty of room for broad market volatility to increase significantly if the headlines get worse or contagion spreads.
Yeah, natural gas options.
We anticipate about a 3 to 4 cent bid higher priced in. The combination of summer heat wave demand plus those LNG reroute fears we talked about is currently lifting its implied volatility curve too.
So this snapshot gives us a clear picture. High fear in oil, moderate concern in stocks and gas, but potential for VIX to spike.
That's a good summary, yes.
Okay, let's talk tactics. Specific ideas for different views, using options with defined risk, which sounds crucial right now.
Absolutely. Defined risk is key.
So if you're like some traders who think oil is going to spike and stay bid, you're bullish on oil, what's a potential play?
Well, you could consider a long call spread on USO. USO is the big oil ETF. For example, you might buy the July $80 strike call option and simultaneously sell the July $88 strike call option against it.
Buy the lower strike, sell the higher strike.
Exactly. Or you could do a similar call spread on XLE or XOP, the energy sector ETFs.
Why does this strategy fit now?
Because it limits your upfront cost, your premium outlay, which is important when implied volatility, IV, is already elevated like it is in oil. Calls are expensive, but it still gives you upside exposure if Brent crude does test that 90-95 baud range. You profit if oil moves up, but your max profit is capped at the higher strike you sold.
And risk control is built in.
Your maximum loss is limited to the net premium you paid to put the spread on. To further control risk, especially against time decay or theta bleed.
Theta bleed, the daily cost of holding the option.
Right, the rent you pay. It's generally wise to keep the width of the spread, the distance between the strikes, like $8 in that example, maybe less than or equal to 10% of the underlying asset's value. That helps manage the impact if IV crushes or time passes without a big move.
Okay, that's the bullish oil view. What if your main concern is needing disaster insurance, protecting your overall portfolio against broader market fallout?
A different strategy is needed there. You might consider buying put spreads on the SPY or QQQ. Those are the major S&P 500 and Nasdaq 100 ETFs. Maybe look at August expiry to give yourself some time.
Buying protection against a market drop.
Exactly. Or, alternatively, maybe a VIX call spread, like buying the July 25 strike VIX call and selling the July 30 strike VIX call, betting on volatility itself increasing.
Why do these hedges fit now?
Because, as we noted, S&P 500 volatility levels are still relatively cheap compared to crude oil volatility. So buying this protection might be more cost-effective right now. It hedges against broader market contagion if the crisis escalates.
Risk control on these hedges.
Again, define your maximum loss up front, which is the net premium paid. And a critical warning, especially with the VIX, Avoid buying naked VIX calls.
Why is that?
The VIX term structure, how volatility is priced across different future expiry dates, can get really distorted and invert violently in these situations. Naked VIX calls can lead to unexpected and potentially massive losses if you get the timing or structure wrong. Spreads are generally safer.
Okay, good warning. And remember, folks, friends don't let friends go naked options. It's like streaking in a war zone.
Precisely. Too much unpredictable risk.
All right, let's nail down some crucial do's and don'ts for the next 72 hours, specifically for options trading in this environment. What are the key DOs?
Okay, do number 1, always check the implied volatility versus the historical volatility HV before you enter any options trade. As we said, crude VAV is already high, suggesting options are expensive. Equity VAV might still be relatively cheap, potentially offering better value for hedges. Know what you're paying for volatility.
Makes sense. Do number 2.
Do use defined risk structures, things like vertical spreads, calendar spreads, butterflies, rather than just buying naked calls or puts or selling naked options. This is fundamentally about capital preservation. Set your maximum potential loss up front.
Okay, what else?
Do consider staging your orders before Sunday's Globex market open. Liquidity of you've used is to be very thin right after a major weekend event, and the bid-ask spreads can be extremely wide. Placing orders beforehand might help.
Good practical tip. Another do.
Yes. Do scale into your trades carefully. Don't commit more than, say, 1% to 2% of your trading account capital per trade, especially now. Geopolitical headlines have a nasty habit of causing markets to gap beyond your theoretical maximum loss on a spread. You absolutely don't want to be overexposed if that happens.
Prudent position sizing. And finally,
do keep a very, very close eye on official statements coming out of Washington and Tehran, and also from shipping insurers regarding the Strait of Hormuz. A single tweet, a single official declaration can shift market sentiment, option skew, and implied volatility literally in seconds. The whole landscape can change instantly.
okay, those are the do's. Now, critically, what are the don'ts? What should people absolutely avoid doing with options right now?
Number 1, don't chase late-day IV spikes after the premium is already, say, double its 20-day average. At that point, the probabilities are heavily skewed against you. You're likely paying way too much for the option, buying at peak fear.
Don't overpay for volatility. Got it. Next.
Don't sell naked calls on oil ETFs or futures, please.
You sound serious about that one.
I am. The tail risk here, the potential for an extreme upside move in oil, is highly asymmetrical. We talked about $120 plus scenarios being possible if Hormuz is disrupted. If you sell a naked call, your potential losses are theoretically unlimited if the market rips higher against you. It's just not worth the risk.
Okay, no naked oil calls. What else not to do?
Don't just assume the Federal Reserve will ride to the rescue with quick rate cuts if this escalates. A sustained period of $9,100 oil could actually delay any planned easing by the Fed. It could even lift real yields, interest rates minus inflation.
Which would hurt certain assets.
Yes, that would likely be detrimental to long-dated call options on growth stocks, which are very sensitive to interest rates. So don't bet on Fed cuts as a certainty.
Okay, another don't.
Don't over-concentrate in those leveraged energy ETNs we mentioned earlier. Their internal mechanics, the daily rebalancing, can cause significant decay, amplifying losses during volatile whipsaws. They are tricky instruments best used very short-term, if at all.
Right. Handle with care. And the last, don't.
Don't forget about those natural gas crosswinds. The LNG shipping risk interacting with high summer heatwave demand can spike natural gas volatility unexpectedly and distort pairs trades you might have on. Understand those interconnected dynamics.
Okay, so pulling back, again, looking at the big picture from the options market in this chaotic environment, what's the overarching message? What's it telling us?
Well, the options markets are flashing a pretty classic conflict pattern right now. You've got crude oil volatility exceptionally high, showing extreme concern there. Equity market volatility is lagging behind, suggesting concern but not panic yet. And the skew, the price difference between calls and puts, is richly bid to the upside in energy, people paying up for calls, and to the downside in broad indices, people paying up for puts.
So, protection buying in stocks, speculative upside buying in oil.
Exactly. Smart, experienced traders understand that in this environment, you generally want to rent volatility, not marry it.
Rent it, don't marry it.
Meaning using time-boxed strategies like those defined risk spreads we discussed lets you participate in potential moves without excessive theta bleed or time decay if a market chops around.
Okay.
Also, consider pairing trades, like maybe long energy calls funded by selling discretionary puts to try and balance out your sector risks.
Interesting idea.
And critically, you have to reevaluate your positions almost daily. If Iran's response turns out to be surprisingly muted, expect a swift crush in implied volatility. Premiums will deflate fast. But if tankers actually get hit in Hormuz, be ready to pivot quickly, perhaps from defined risk spreads to outright Delta One hedges, meaning direct short positions in futures or ETFs to fully hedge market risk.
So stay nimble, adapt quickly.
Always, but above all, capital preservation always trumps chasing headlines. Protect your principal first.
Okay, this is where we bring it all together. We've covered the event, the history, the gurus, the sectors, the options.
A lot to digest.
Definitely. Now, what does this all mean for your portfolio listening right now? We've distilled it into a clear do's and don'ts action checklist, your investor playbook.
Right, let's start with the 3 key do's. First, do stress test your portfolios. Seriously, assess your specific exposure to a scenario of $90, $100 oil. How much of your portfolio is in energy-heavy stocks versus sectors vulnerable to high fuel costs, like transport or consumer discretionary?
Know your weak points before they become a problem.
Exactly. Understand where you're vulnerable. Second, do consider tactical hedges. This could involve adding some exposure to oil-weighted ETFs, maybe XOP for the exploration and production companies, or XLE for a broader energy sector exposure. Or, if you're a more active trader comfortable with options, maybe using those longer-dated call spreads on Brent or WTI futures we discussed. The absolute key here is using defined risk positions. Know your maximum downside.
Okay, stress test, consider hedges. What's the third do?
Do maintain inflation hedges. This is crucial. History, from the 1970s oil shocks right up to early 2022, consistently shows that assets like gold and DPS, Treasury inflation-protected securities, tend to outperform during these kinds of supply-driven inflationary shocks.
They hold their value better when inflation spikes.
Generally, yes. Also, consider holding quality dividend-paying stocks in resilient sectors. Think pipelines, utilities. They can provide a steady income stream and some stability during volatile periods.
Got it. Any bonus dues?
Yes, a quick bonus, especially if you're near or in retirement. Do raise a cash buffer. Aim for maybe 3-6 months of living expenses in cash or cash equivalents. Why? Because high volatility can severely dent your portfolio value right when you might need to draw income, what's called sequence of returns risk. Having cash provides a vital safety net so you don't have to sell stocks at the wrong time.
Good advice for retirees. And keep watching the news.
Definitely. Monitor those official statements from Washington, Tehran, and especially shipping insurers regarding the Strait-of-Hormuz status. Prices can reverse very quickly if it becomes clear that oil and gas flows will remain safe.
Okay, those are the crucial do's. Now for the equally important don'ts. What should investors avoid doing?
Don't. Number 1, and this echoes Buffett, don't panic sell your diversified equity positions based on the scary Sunday night futures or the initial market headlines on Monday morning. History strongly suggests that these knee-jerk exits after headline spikes, think back to Soleimani in 2020 or Abqaiq in 2019, often lead to significant underperformance because markets frequently reverse those initial losses within days or weeks.
Keep your head, as Buffett says. Don't react emotionally.
Exactly. Number 2, don't chase parabolic crude oil moves with large amounts of unhedged leverage. We've said it before, but it bears repeating. Those sharp reversals, the whipsaws, frequently follow the initial spikes. Avoid getting caught on the wrong side with too much risk, and absolutely avoid selling naked calls on oil ETFs or futures that tail risk of $120 plus oil makes it incredibly dangerous.
Okay, no panic selling, no chasing with leverage. What's don't number 3?
Don't short energy immediately just because headlines scream peak fear. That geopolitical risk premium we talked about can linger for weeks, even months. If a cycle of retaliation unfolds slowly, you could get run over trying to call the top too early.
And related to that,
Critically, don't assume the Fed will automatically cut rates soon to cushion the blow. As we discussed, $100 plus oil would more likely delay any planned easing and could lift real interest rates, potentially hurting long-duration assets like growth stocks or long-term bonds.
so don't fight the Fed and don't assume the Fed will bail you out here.
Yeah.
Got it. Any bonus don'ts?
Yeah, quickly. Don't ignore that natural gas sensitivity. High summer temps plus LNG rerouting issues can definitely hurt energy-intensive industrials while helping specific gas-weighted energy producers. Understand those nuances. And maybe most importantly, don't bet everything on a single peace breaks out tomorrow scenario. As multiple sources highlight, there are many possible pathways this conflict could take. Your portfolio needs to be robust enough to handle various outcomes, not just the most optimistic one.
Be prepared for different possibilities. Excellent advice. And remember, everyone, panic is cardio for portfolios, gets the heart rate up, but rarely improves long-term health.
Well put. Stressful, but not productive.
So wrapping this all up, what's the ultimate takeaway from this deep dive?
Ultimately, what we've seen today, reinforced by history, is that headline shocks alone the initial news. The rhetoric rarely keep oil prices significantly elevated for more than a few weeks. It's only sustained physical supply loss, like we saw in 1973 with the embargo, or 1979 with the Iranian Revolution, that truly extends an oil rally for many months or longer.
And natural gas spikes.
Even more selective. They tend to erupt only when gas flows themselves or critical LNG choke points like Hormuz are directly and physically threatened or disrupted, impacting actual supply delivery.
So translating that to today, if this current U.S.-Iran tension stays largely at the level of headlines, sanctions, maybe some limited tit-for-tat retaliation that doesn't stop the oil tankers,
then you'd expect Brent crude to probably spike into the high 80s, maybe low 90s, driven by that fear premium. But then likely retrace much of that gain once it becomes clear that tankers are still moving and global supply isn't fundamentally broken.
the big but.
The big but is if a single missile or naval mine or some other action genuinely halts significant traffic through the Strait of Hormuz. If that happens, we could absolutely see a repeat of those 1990s-style price doubles, or potentially even worse given today's tighter market, until eventually spare capacity is deployed and demand destruction kicks in to cap the move. It all comes down to the physical flow of barrels through that strait.
Which leads to a really important question for you, the listener, as you process all this.
What's that?
How will you maintain your discipline? How will you stay nimble in your investing approach when the headlines are screaming, fear is palpable, and maybe even driving market moves day to day?
Yeah, will you let emotion dictate your decisions? Will you get caught up in the panic?
Or will you stick to a predefined, rules-based, defined risk playbook that you've thought about calmly in advance? Something to really consider.
Crucial self-reflection for any investor.
Okay, looking ahead. Next week on the deep dive, we're shifting gears slightly, but sticking with critical market drivers.
What's up, Kat?
We're doing a special deep dive into the Federal Reserve's upcoming interest rate decisions. What do they mean for everything from your mortgage rates to your stock portfolio?
And importantly, will these rising inflation pressures, potentially fueled by this geopolitical tension, force the Fed's hand? Could it delay those rate cuts everyone's been hoping for even further?
Exactly. That's what we'll be exploring.
So make sure you're subscribed to the deep dive so you don't miss that crucial episode next week. You can find us on all major podcast platforms. Just search The Deep Dive.
And as always, a reminder, the information shared in this deep dive is intended for educational and informational purposes only. It is definitely not financial advice.
Please consult with a qualified financial professional before making any investment decisions based on what you've heard today.
Stay safe, stay informed, and we'll talk to you next week.